Good morning, everyone. Thank you very much for joining. Today is one of the first webinars of June that we are doing, where we talk about financial prudence, financial management in all aspects of life, business, and other things. So I'm very excited about how June has panned out. Anything related to money has been kind of panned out from a learning curve perspective at its way for you, for everybody in the community. And this is actually not the first, but the second webinar related to finance. And it is from one of the people I personally respect a lot. I have learned a lot with the few interactions that I've had with her. I've learned so many things and I've already started implementing them. So it's really a pride and honor for me to introduce with you today's speaker and masterclass host or tutor, if you want to say, Simran Samtani. She is the co-founder and senior partner at Excel Accounting since the past 15 years. She's passionate about empowering entrepreneurs, building a profitable, scalable, and sustainable business. She's all about growth and profit. She's a strategist, especially passionate about being an exit strategist for people who want to get out of their business and, be rest assured it's still going to run. She's the one to go to. She's also a mentor, and she helps business owners keep more of the money they make by intentionally building a business that's funding their freedom and their lifestyle. The services Excel Accounting provides are value builder engagement, profit first consulting, outsourced accounting services, business valuations, built for profit CFO services. Over to you, Simran.
Thank you, Armin. Thank you so much. And morning, everybody. I will be sharing my presentation. And before I begin, welcome here. You could have been anywhere today, but you've chosen to spend your time here. And I totally will ensure that you will make maximum out of the time that you are putting in here. I'll just share my screen. So we'll get straight to it. Just give me a moment. So a little bit about who I am and what we do. So as Armin already said, Excel Accounting, I've been with Excel Accounting for 15 years. We're going to be completing 20 years as a business in August actually, and it was started by my husband. We are life and business partners. We pride ourselves in saying we're the firm of the future, and it's not just about numbers, it's going beyond numbers and being a success GPS. So as I said, we empower business owners to take strategic and business decisions. We have a 20-year-old, 19-year-old firm now, 20 in August. And a little bit about me. I'm not an accountant, and I speak in a language that an entrepreneur will understand. I'm an entrepreneur myself. I have 25 plus of years of experience in marketing. I'm an MBA in marketing, but I've been an ex-banker, so I'm not averse to numbers. And I have been a top performer in Citibank. I used to be in Citibank for 9 years before I joined my husband in the business. And I was selected as one of the 40 women all over the world by Vital Voices. It's an organization that runs it's run in the US. It's a nonprofit organization that supports women entrepreneurship. And we are the only, as a business, we're the only certified value builder and profit first professional. So when we say we help businesses grow and profit, it's not our strategies. These are proven, tested strategies, experienced by 50,000 plus firms all over the world. So why do people get into business? There are many reasons. Like we have a cushy job, we leave that, we leave an 80-hour a week job, a 40-hour a week job to spend 80 hours in our business for various reasons. Some of the reasons that we believe that people leave their jobs are, of course, want more money and believe that you can make more money by yourself than what your jobs are giving us. Flexibility, spending more time with family, being flexible in terms of, when our family needs us, do what we want to do, when we want to do, and of course, freedom. And freedom could be time freedom, money freedom, location freedom, whatever it means to us. My question is, do we get this immediately, or we give more of each of this when we start our business? Entrepreneurship is a lifestyle. It is not easy, but yet, it gives you a lot more, and we need to know what we want and why do we get in our business. So it's more easier, successful to win in a Las Vegas casino than succeed in your business. 82% of businesses fail in their first 5 years. But in gambling or in a casino, you have a 50-50 chance. Yet we all want to spend our time and energy, everything and money putting into our business. So shouldn't our business give us the lifestyle that we want? Top 5 reasons why businesses fail. Like I said, 82% of businesses fail. It could be because you've started with not enough money, lack of a business plan, your pricing strategy. Our pricing strategy is not right. We are over optimistic about how much money would be required. And 82% is because of poor cash flow management. And we'll talk a little bit more about that going forward in our session today. So let's start and begin with an end in mind. Okay. As Peter Drucker says, what gets measured gets managed. A lot of people don't understand numbers, don't track numbers. And one of the traits of successful CEOs is that they know their numbers. I want each one of you who are present here today to go back and say, I know my numbers. The reason is a lot of people fear money. And our journey today is to move you from fear to faith in your finances. Okay, so what do we have to measure? There are 2 kinds of indicators. I'm starting with the end in mind so that you know how this will all pan out. There are 2 kinds of indicators. One are called leading indicators and the second one is called lagging indicators. Lagging indicators are those indicators that help you analyze your past performance, but leading indicators are those indicators that show you your way ahead. Okay, so all the financial numbers that we talk about, our profit and loss statement, our balance sheet, and all of that are actually lagging indicators. And we have to use them to make decisions in our business, to make informed decision in our business. And that is leading indicators. So the 2 things that are very important is data that will help you take the right decisions. As entrepreneurs, maybe you will not do your own accounts. Maybe you will outsource it to an accounting company like ours. Maybe you will hire someone who will do your accounting for you. Maybe you have a family member who's helping you out with your numbers. But at the end of it, as a business owner, you're in control of your business. You cannot delegate that responsibility to whoever's giving you that numbers. But the fact is, you should be able to read the numbers and ask the right questions to your accountant, to the person who's doing your numbers, and take that data, be able to understand that, and take decisions based on that data. All right. So what is accounting and why is accounting important? Accounting is a language of business. Okay. We all have pets, or we know someone who has pets, right? Do we speak the same language, but do we communicate? Absolutely. We can communicate without knowing the language. So exactly that, accounting is a language of business that bankers understand, that investors understand, that all your authorities, your FTA, for your VAT, for your tax, you'll have to speak that language. And that's the language that provides you information that can help you take timely and correct business decisions. So irrespective of who's doing it, you'll need to at least read the statements, understand the statements. So there's a difference between 2 words, bookkeeping and accounting. Bookkeeping is record keeping, is actually just putting in the data into a system or an Excel sheet or whatever you use. And accounting is a process of preparing and analyzing financial statements. So that's the analysis of all the statements that you are doing. So accounting goes beyond bookkeeping. So you may have people that can help you with the bookkeeping, is just putting your data, but the analysis is not coming out. And the meaning is what makes it important for you to take decisions. So that's a difference between accounting and bookkeeping. Now, who looks at this data? Business owners, investment firms, banks, regulatory bodies. If you want a loan, all of them will ask you for your financial statements. So there are 3 functions of accounting, and we will go through this presentation accordingly itself. One is score keeping, which is more like your bookkeeping and keeping all the information that you need. Second is directing your attention to what you need to read in that. That includes the 3 financial statements, which is accounting. Just give me 1 second. So attention directing, this is about 3 financial statements, which includes your balance sheet, your profit and loss, your cash flow, and we will spend time understanding each of these statements in our journey here today. And at the end, how will you take this to make decisions for your business? It could be, I don't like to use the word problem solving, but it will identify where your attention needs to go, what you need to highlight. It talks about growth. It could also be taking action and solving any challenges you might be facing, which could be collections is not proper or any of that situation as well. And then, so we start with scorekeeping. So in scorekeeping, what am I going to do is talk to you and explain to you accounting terminology. So we'll spend some time in understanding these terminologies before I share about the 3 financial statements and putting them together. So the key accounting terms that I'm going to talk about is, first is called the GAAP. GAAP is nothing but generally accepted accounting principles. So when your banks, your other FTA, all of them want your financial statements. They would want you to be following GAAP. There's another word that is called IFRS, which is International Financial Reporting Standards. All of the corporate tax, the VAT have to follow IFRS as well. Okay, so now the first and the foremost word that I will talk to you about. Now, some of you might be using accounting softwares, and which is what I will highly recommend everybody to use cloud-based accounting software to do your accounting and not do it on Excel sheets, because for VAT and corporate tax, for VAT, you need to keep all your information for 5 years. For corporate tax, you need to keep it for 7 years. And if they are kept in an accounting software, these are accepted. You don't have to, keep a shoebox of receipts. You can scan these receipts and have them into your accounting software. These accounting softwares are not expensive, and you can have it as an app on you. So whoever is doing it, you as a business owner can have a look at all your numbers at any given point of time. Now, chart of accounts is nothing like when you start a book, it's like the index. It actually puts every single aspect where money is going in or money is going out in a format. It's nothing but, keeping a track. So now what happens is, I will go into details of each of these later on, but in a business, either money is going in or money is coming out. You can either are getting money in by way of income, or you're spending in terms of expense. So all income related stuff comes together as one chapter, and it starts from a series of numbers. Say you're starting the series from 1. Expenses would be all money going out, would be expenses. Then there's a difference between assets and liabilities. Assets are things that you own, would have another series, and liabilities are things that you owe to the others, would come in another series. So what happens is, if you have multiple businesses, our recommendation is to follow the same series of accounts, so that if you're putting a group of businesses together, it's easy to put in. And same thing with equity. So that's what chart of accounts is. So what assets would be your different checking accounts, your liability. I can come back to this if you have any question and answer later. It's right now is just to understand that you're logically classifying the information in a format that you could then put it all together to do an analysis later on. My recommendation is, even if you are a very, very small business, definitely get your accounts set up by an accounting firm, even if you were to do this yourself, because this is a very important feature. And especially with tax coming in, there would be changes that you would need to make in your current chart of accounts as well. So a classic example that I would give you for tax is, there are certain deductible expenses and certain non-deductible expenses. So for example, in expenses, any entertainment expense that you will spend for your clients, for your suppliers, you will get 50% deduction of it. Any expenses in corporate tax that you would spend on employee entertainment for your employees, you can get 100% of the deduction. And any other expenses like maybe bribes or fines and penalties is 0% deductible. So in your chart of accounts, you'll have to track them separately, so that when you're filing tax, these will have to be put separately. So there's no confusion, and you're not looking back at the receipt and saying, now what is 50%, what is 100%? Okay, all of that. So understanding that, classifying that information, categorizing them properly becomes very important. The next system that I want to talk to you is about a difference between cash accounting and accrual accounting. Now, the generally accepted accounting principle says we should follow accrual basis of accounting. Now, what's the difference between this is when are you going to recognize the money coming in and money going out? For small businesses, what happens is you can, for the FTA, for corporate tax, they're allowing up to, if you're doing less than 3 million dirhams in revenue, cash basis is allowed, but the recommended basis is accrual basis. Now, so what's the difference? Say I make a sale in January, but the customer pays me in March. In a cash basis, you will put income in March. Okay, in an accrual basis, you will put it in Jan, where you've actually made the sale, irrespective of whether you've received the money in Feb or March. The same thing with an expenses. I've gone and bought a laptop in the month of January, and I paid my supplier in the month of February. In an accrual basis, I will mark it in January, but in a cash basis, I will mark it in Feb when I actually pay the money out. So now, when the actual money is going in or coming out is cash basis. Accrual basis is when it's actually happening in your business. The preferential methodology is accrual basis, so that you're actually representing your business as the transactions are happening, not related to when the cash is coming in. So I hope I've made this clear. And so that's the difference between cash basis and accrual basis. These are terminologies that you will keep hearing now, especially with the tax coming in. Then there are words like assets. Assets are things that you owe. We'll spend more time actually preparing a balance sheet later on. So we'll go into depth of this. So assets again can be divided into current assets and non-current assets. So the current assets are any of your asset that will be converted to cash in 1 year or time. A long-term asset is value to the company after even a year. So say example, you have a property is a long-term asset, but intangible assets are those assets that cannot be touched. So this could be your branding, your trademark, etc. They're assets for you because they will add goodwill to your business, but these are not physical assets. That's why they're called intangible assets. Similarly, with liabilities is what you owe outside. And one thing also a lot of people have heard is called break-even point. Now, break-even point is a point in your business where you're neither making profit nor making loss, which means you're equal at that point of time. It's also called the point of equilibrium. So a lot of people will say, okay, and break-even analysis is making an analysis of when you will be achieving a break-even point. So when you start a business as a startup, you're spending more money than you're making money, right? So you want to reach a time where all that you've invested in your business, you make back. So you calculate and say, am I going to break even in 1 year? Am I going to break even in 6 months? Am I going to break even in 2 years, etc.? And hence, understanding your break-even point is very important for any business. Reconciliation is another word you'll hear a lot of accountants say, a lot of bankers say. It's nothing but matching. So there are your bank statements and there are your actually numbers in your books. You always have to match. It could be reconciling your vendor suppliers. So your supplier sends you a whole list and you're matching it against the money that you've received. That these items were sold and this is the money. Is it matching? So reconciliation, a simple word to understand, is matching. And at the end, when you're doing your books, everything needs to match, and reconciliation needs to be done because there are times when there are transactions that have got slipped up, the money from your system. Say you have an e-commerce, the material has not been uploaded correctly into your accounting book. So there's always this gap where it's not matching, and reconciliation is a process of going back, looking and matching everything so that before you generate your books, before you finalize your books, you've made sure all the checks and balances are in place. Then other two words that are important, these are cash. So whatever we've been talking about are actual cash related transactions. These two are cashless transactions. Depreciation is nothing but taking your amount and spreading it over 4 years. So taking an asset that you've spent for, but the use of the asset is 4 years, 5 years, whatever. So you'll spread that over that period on that it's being used for. So for example, your laptop that you've bought for your business, maybe you've incurred the expense today, but you're going to be using the laptop minimum for 3 years. So you will, or 4 years, or whatever that year that you will decide. So you will spread that cost and divided it by 4 years. And amortization is nothing but the same thing like depreciation, but it is for an intangible asset. So a car, a machinery would all be depreciated, but R&D, trademark, branding exercise, if you're a restaurant, menu design, the amount that you're paying would be across. And in terms of the how many years it needs to be depreciated, some of them are standard, but otherwise it's by individuals as to see what do you think is the usable period, when will you be doing rebranding again. So generally between 3 to 5 years you will spread that cost. Yeah. So cool. We've done any questions so far? I'm not being able to see any questions right now. So if not, we will go to the question and answer at a later stage when we finish.
Simran, I have a question.
Okay.
Would you like me to ask it or send it in the chat? I've
No,
got
no.
a question.
I've removed the screen, so you can ask me right now before we go to the next.
Cool. You mentioned cash and accrual basis and how you do your accounting,
Yes.
the two differences. Now, a question arises where how you can transition from one to the other, and is it important to transition from one to the other at a certain stage of the business?
See, ideally for now, I would definitely ask everybody to transition. So, so for corporate tax, okay, that's making things quite regular. So for corporate tax, I would ask people to find out what your financial date is, your official financial year. They will find it in Article of Association. Definitely do it before that point. And because if you want to change your system, you'll need to inform the FTA as well that you're changing the system. So my recommendation would be to do it as soon as possible. It would not take you too much of a time to do it. You can, so say for example, you complete June, and from 1st of July, you move to another accounting system. There'll just be a slight variation that you may have to do.
All right, thank you. Thanks.
Yeah, so definitely start it before the tax period starts, now that we have that opportunity in this country.
Great. And are there any indicators where you would recommend businesses to transition from one to the other?
See, we as accounting firms, we only recommend accrual basis for each of our client. Even if they were on cash basis, the moment they sign up with us, we follow accrual basis. Yeah, and that's the recommended method, because even if you were to go to a bank for a loan, you may not need it right now, but later on you want to sell your business, you want to do a business valuation, you don't want to go back and correct everything at that stage. So we always recommend people to follow accrual basis. But the FTA has now said that if you're a small business, so what happens if you use an accrual basis of, if you use a cash basis of accounting, you only track balance sheet and profit and loss. You don't need to do a cash flow statement. But if you're following accrual basis, you need the cash flow statement because it's not giving you the right cash position. So it's a cash basis is a simplistic method, which is why startups use it. But the correct method and the accepted method is accrual basis. So if you do have someone doing your accounts for you, we would highly recommend accrual basis only.
Okay, great. Thank you.
Welcome. So I'll share my screen again and we'll now go into the 3 financial statements. So the first important measure, which I said, any government authority, FTA, for business valuation, for bank loans, they will ask you for your balance sheet, your profit and loss, and your cash flow statement. Now, what happens is, we had a company saying that this company is doing 9 million dirhams of revenue. They want to sell it for 500,000 dirham. Should I go and buy it? Okay. The thing is, your profit and loss shows you your income and your expense, but everything, your liabilities are hidden in your balance sheet. So we said, we cannot give you an answer right now. I need to see your balance sheet as well. And that's where we found liabilities. Why would someone making 9 million dirham revenue sell it for 500,000, right? So because there were liabilities in their books. So always you have to look at both the statements and cash flow statement to give a comprehensive view of how the business is doing at this stage. Now, what is a balance sheet? So if I were to say, if a photographer would want to come and take your picture right now, how would you want to look? You would want to look good. You would make preparation that you would want to look good because it's a snapshot. Balance sheet is just exactly that. It's a snapshot of your business at this point of time, not 1 minute earlier, not 1 minute later, because things can change. Okay, it's at this point of time. How would you want your balance sheet to look if somebody were to come and look at your business? It is what you own. So what are your assets? What you owe are your liabilities, and whatever is remaining is your equity. That's your stake. Okay, that is what a balance sheet is. And it is always at a specific period of time. So whenever you're reading a balance sheet, it will be as of 31st December 2022. As of, it could be monthly, it could be quarterly, whatever is that time period, it will tell you when it is as of that date. So we normally say at the end of the year, it's as of 31st December 2022. Okay, a profit and loss is how much a company is generating money, how much it is spending during a period of time. So normally when you read a profit and loss statement, it will say for the month of January 1st to January 31st, or from January 1st to March 31st, if you're looking at a quarterly profit and loss statement. Okay, so quickly telling you the difference between the two. Like I said, a photograph is your balance sheet. So imagine you're watching your favorite game. Okay, so say it's a football game and you had a very, very, very important meeting. So you missed it, but you got it recorded and you're now watching the replay. So when you're watching the replay, you realize that the referee said penalty and you felt it was not correct and you're angry and you're upset. You pause it, you rewind it, watch it in slow motion and say, okay, now it's fine. You watch the game again, there's a goal by the opposite team and you're frustrated. Oh no, I think I had missed it. Why did he give it a goal? You go back, you pause, and then you look back again on slow motion. So now what happens is at the flow of events where you're freezing and pausing, between the two pauses is your profit and loss. Okay, it's what happening from Jan, how is it going till March? Okay, or how is it going from April to June? But if you at that point of freeze that you've frozen, at that freeze is your balance sheet at that point of time. So that's just simplifying, telling you what a balance sheet is and what a profit and loss is. So I will now come and explain to you this is the link between the two statements. Let's look and try and prepare it. Now, we don't have enough time. Otherwise, I would have done an exercise where I would ask you to prepare this yourself. Now, to simplify matters, if I can say, if you had a shoebox of receipts, okay, you know money is going in, money is going down. Even if you don't have a receipt and happening online, if I tell you to take small pieces of paper and write down, okay, every item saying sale number 1, sale number 2, payment for my telephone bill, payment for my electricity bill, you can do it in two ways, right? Money is going in, money is going out. Yes, simple. If I give you this and say, put money coming in one drawer and money coming out in one drawer, you can do it. Easy, correct? Right? So that I'm trying to simplify it. I hope I can simplify it. The same thing what I will do now is make it into 4 drawers. All right? I hope I can show you 4 drawers. It's asset, liability, income, and balance sheet. So now money coming in can be divided, like a profit and loss can be divided into income and expense and assets and liability. So you divide it into 4. Now all the money coming in and money going down will not go anywhere else but in these 4. Okay, that is clear. So now what goes where is what we will talk about right now. So if you were to just make this into an Excel sheet or put it in drawers, all you need to do is money coming in, money going out. Out of money coming in, it'll be divided into 2. Out of money going out, it will be divided into 2. So the balance sheet is nothing but like you prepare a T diagram and say liabilities and assets, income and expense. Now we'll go into what falls into each. Now, liabilities are anything that you're bringing money in. So you could have put in your own money and brought in your own capital. You could have taken a loan from someone else and brought that money. You could have used creditors who've borrowed the loan. So you have either investors, a loan, capital, however you've got your liability, because you need to pay this back. It's not your own money. Okay, then using that money that you've got, you've bought some assets. You could have bought a land and equipment, you have inventory, you have bought certain things. And profit and loss would be income is a sales income or other income. And I'll explain what other income is. Expenses are whatever you're spending, your salaries, your admin. And then what you say is there are 2 credits and 2 debits. Okay, whatever is money coming in is a credit to yourself, which is positive. So money is flowing in. So the money flowing in is either a liability, okay, because you have to return it, but it is still money flowing in. And sales is not a liability, but it's an income that's coming. It could be coming, sales could be from sales, and maybe you've borrowed a lot of money from your investor and you've put that under interest, and then you're making that interest, and that could be a part of other income. So money coming in is credit, money going out is debit. So any money coming in will be divided into either it's a liability or it's an income. Money going out, which is where these four drawers come in. Okay, money going out will either be an asset that you have built, or it could be an expense that you're giving salaries. Okay, and whatever is remaining, my income minus expense, will either give you a profit or a loss. It's also called, so these are sources of funds and these are uses of funds. All credits are sources of fund, all debit is how you've used your fund. Okay, the sales is called the top line and the profit is called the bottom line. And if you say it's in the black, which means you're making a profit. If you have, some people have said you're in the red, that means you're making a loss, whereas your income is less than your expenses. So this is simplifying the profit and loss and balance sheet. Now you'll say, if it's money coming in, it's not clear that whether it will be a liability or an income. Absolutely. Okay. So say, for example, you're an interior design firm and you've got 50% of sales in advance. So the entire amount does not go into your income statement. A part of it goes into your income statement and part of it goes into your balance sheet. Okay, the reason being that whatever the difference, I would have spent more time explaining it, but I will tell you the difference in what goes into a balance sheet and what goes into a profit and loss is the level of consumption. So how much ever you've consumed will go into your profit and loss statement. The rest will remain as your balance sheet. So for example, even your rent, you're paying quarterly rent, but in your income statement, you will only take the 1 month rent and the remaining will appear in your balance sheet. Similarly with expense, your salary. So say, for example, your staff is going on leave and is saying, can you give me 2 months salary in advance? Now, only the salary for this month of June will be in your expense. The rest of it will be in your asset, because if he or she doesn't come back, then you can use it against the gratuity. Understood? So the same thing can go into your profit and loss, or the same thing can go into your balance sheet. So whatever is not consumed becomes your asset and it is in your balance sheet. Whatever is consumed from the advance becomes a part of your profit and loss statement. Is it clear? Is it simple enough? Okay. Okay. And what we can do is we can, go into the details later on if you have any questions. So that's simplifying so that even if you were as a small business owner trying to do your own accounts, you understand it. If your accountant is doing for you, you can question if it's not happening this way. Okay. So now the third statement comes in, and if you're following your accrual basis of accounting, that is where the cash flow statement comes in. Irrespective, cash is king. Okay, it's the oxygen to our business. Let me clarify here is profit is not equal to cash. A sale is not a sale until a cash is collected. Similarly, your bank balance is not equal to your cash balance, which means your accounting system has your cash balance, which is your cash flow statement. So today, if a vendor comes to you and tells you that, listen, I can give you a 50% discount if you buy the items today. You anyway need it for the year. Now, for you to be able as a business owner to take that decision, you go and do something called bank balance accounting. You go, you check your bank and say, oh, I have the money, I will avail it. But what you've not realized is probably a rent check is going out tomorrow. Probably there is something else that you've already promised a vendor, and you have a check that you've given to them for an equipment that you've bought. And you've made that decision without looking at your cash flow statement decision. Okay. So now there is a method that I will talk about in my next workshop, which is financial prudence, which is happening on 26th, where I'll go into the detail and see how you can leverage bank balance accounting for you. But at this point of time, we have to remember a sale is not a sale till the cash is collected. And as we had said, 82% of the businesses failed because of poor cash flow management. And if you don't have cash, you cannot pay, you cannot run your business, even if you're profitable. So the pillars of any business success lies in two things: ability of the business to generate profits and ability of the business to manage cash flow. 82% of the businesses fail due to cash flow. But remember, the statistics that I had not shared before, 69% of them were profitable. Profitable on your profit and loss statement, profit on paper, but did not have the physical cash. Your accountant comes to you and say, hey, you've made a profit of 1 million dirhams. And you'll say, where's the money? Because the money is not reflecting in your bank account. It is not the same. Okay, so it's a very, very important to understand. And I want each member here to be a part of the 18% club, which is the 18% of businesses that survive. Okay, survive beyond the 5 years, survive for 15 years, survive for 20 years and more, or have a successful exit. So that's what we need to work on. Now, I will spend a little bit of time on this. I run another workshop where I tell you how to find hidden cash in your business. We'll not have time to go through each of it, but I will do 1 or 2 over here for you. So basically, it's simple, right? In a business, money is currency, it's flowing. Money is coming in, money is going out. In COVID, we've realized when people started stopping the flow of money, like water, if the money flow stops, it becomes stagnant. Okay, so people even who had money were not paying. For the economy to run, for business to run, the money needs to flow, but we need to get it with financial clarity and direction for it to flow in the direction we want it to flow. So how does the money come in? The money comes into our business like we saw in the balance sheet and profit and loss statement. Either we're putting it, bootstrapping our own business, bringing our own money in. We have investors who are investing in our business. We are using trade finance, and I'll talk about it. Or we have customers through income buying our products, and that's different ways the money is coming in. The money is going out, whether we've rented a place, bought our own place, bought assets, bought inventory. If you're selling goods, e-commerce business, retail businesses, we have suppliers who we have to pay. We have employees who we need to pay salary. So whether it's service or product, there's money coming in and money going out. And there are strategies that we can adapt to ensure that there is more cash. The ideal way is to get the cash in as early as possible and give the cash as late as possible. Simple? It is simple, but not easy. Right. So at different businesses, you have different negotiation terms. Now, so the reason that the stuff we can look at in terms of inflow is pricing. Okay, a slight shift in your pricing can get you more cash. There are 17 different pricing strategies. Some could be value pricing, some would be, cost plus pricing. I won't discuss it, but it's a strategy that one needs to, whatever you choose, it has to be well thought of. Okay, collecting debt. So we all are in a situation at some point of our time in our business where money is not coming in. So how do you go about collecting the money that's not there? What are the incentives that you can provide? What are the systems that you can provide? That brings us to trade finance. Now, trade finance is called, something it's called bill discounting, factoring. So now, did you know that sometimes there are institutions, financial institutions and bank that allow you to collect the money? So for example, you have 100,000 pending with a supplier, and you want the money today, but you have an agreement with them that they will pay you after 90 days of invoicing. But you want the money today. So these banks or financial institutions will do their due diligence, will check that this is a big company. Definitely the money is going to come in. They will take a small commission, which could be from 10 to 20% on that money. They will give you the money right now, and they will take the money when the customer actually gives you after 90 days. So that's called bill discounting and factoring, which is being used in the last couple of years, even more during COVID, where, the payments had been slow from suppliers. Timely invoicing. Now, most of our negotiation terms comes from invoicing. Everything is based on invoicing, including VAT. So what happens is there are times, and a lot of times, small businesses don't even send the invoice. And the client will say, it's not my fault. My invoice is 60 days, 30 days, 90 days after you've done the invoicing. Okay, so the few facts over here is invoicing timely, making sure you're putting everything they need on the invoice. Okay, the name of the company should be correct. The TRN number should be mentioned. All of that needs to be mentioned so that they don't come back and say, now you recorrect the invoice, and then they take 30, 60 days from that. These are games which everybody has played in the past. So making sure it's not only timely, but correct invoicing. There are statistics that normally in my other cash flow seminar I would shared, but since we have lack of time, I'm just briefly going through it. And customers, 80-20 rule. 80-20 rule, we all know, it's also called the Pareto principle. And you will observe that 80% of our revenue comes from 20% of our customers. Similarly, most of our collection also, 80% of our collection will be from 20% of our customers. To identifying where is those repeat patterns happening, where the flow of the customers is coming, how can we sell them more to get more cash in, and wherever collections are being stocked, what do we do to handle those? So not making changes for everybody else, but shifting your strategy, shifting your collection strategy, and negotiating terms with your vendors, which is the next step, is very important. Never negotiate out of fear, because people can figure that out, but never fear to negotiate. The answer is still going to be no. There's no harm in trying, where you're going to extend payment periods or reevaluate them when you want to. Take a decision whether you need to buy the product or lease the product. So for example, there are dentists, when they start, they have to spend a lot on equipment. So initially you could rent it, and not buy it till you reach a stage where you're making more revenue and then starting to buy. So similarly with where your office is, can you sublet your premise? So if you're working with the same sponsor, you can use sublet your premise. Now, even in salons and dentists, they rent a chair. So you have a hair specialist, you come and rent a chair, the person is a freelancer, you arrive at an agreement where they invoice through you and you take. So there's a rent a chair. Even with doctors, you see that, doctors would have their clinics, but they're also going to other clinics and for consultation one evening a week or twice a week or whatever. So in the medical profession, this happens very often. In spa and salons, it also happens in salons, it happens very often. Hire versus outsource. So what happens is, again, instead of hiring your own resource, outsource. Outsource, I believe, is a strategy that has to be leveraged properly. It's not about today. The question is not whether to outsource, it's what to outsource. Do what you do best, outsource the rest, whether it's marketing, IT, accounting, HR, whatever. You don't have to have all your people under your visa and those costs, outsource. And there is gig economy. We can outsource even by projects. Stock inventory, again, holding a lot of inventory is holding cash. So how much is good enough to hold? How much just in time can you do? If you don't want to do just in time, what is accurate? What is perishable? What is not perishable? Changes by industry. If you need cash flow, you can release some of your inventory and get quick cash. So what are your quick cash strategies? Could be adopted using a lot of these. And similarly, employees, using interns as a win-win, outsourcing instead of hiring all your employees, but also using interns as a win-win strategy. So that's on cash flow. Sorry, I think can you see my screen again, everybody? Cool. So I have also shot some 10 videos explaining accounting terms. So either if you go to my YouTube, you'll get them as a series, or if you follow me on Instagram, you will see accounting simplified. These are shorts. These are short between 30 seconds to a little more than 1 minute. I have explained reconciliation, break-even, accounting. So if any of you want to go follow me on my social media, you'll get some short tips and nuggets if you want to look at it again, either on my YouTube. It's on a playlist called Accounting Simplified, or on my Instagram, it is again Accounting Simplified. So all this that we've understood, it has to reflect into decision making, right, at the end. Now, when you look at these figures, some analysis will glare out. You will start seeing red flags. You'll start seeing, my expenses are high. You'll start seeing percentages that, a big chunk of mine is on salaries, or a big chunk of mine is stuck in inventory. When you do the analysis, you can then resolve it. But what I want to highlight here, and I will spend a lot of time on this on financial prudence, is using accounting as a leading indicator, right from where we started. So your accounting, your financial statement, your profit and loss, your balance sheet, they're lagging indicators. They're telling you what has already happened. Now, you can't go and change that. But using the same tools and forecasting your profit and loss statement, forecasting your future expenses, can help you go back and say, okay, how can I convert these lagging indicators? I have to have a revenue goal. What is my revenue goal as of 31st December 2023? What is my profit goal as of 31st December 2023? So if my revenue goal is X, if I have to do 1 million dirhams, or if I have to do 100,000 dirhams, or whatever your figure might be, how many sales do I need to get to that? To get that many sale, how many calls do I need to make? So your leading indicators would be your daily number of calls, number of proposals you're sending out. So now what you're doing is during the month, you're tracking whether your leading indicators will give you your effective lagging indicator or not. So while your profit and loss statement is your lagging indicator, how will you make sure that as business owners, as decision making, you're taking that data, you're taking your forecasted data, bringing it back, and doing something that I love calling, it's my favorite word, is reverse engineering the whole process to make sure you're identifying the metrics that you want to measure in your business and bringing them as a leading indicator on a daily basis, realizing what are the KPIs, so what are my sales figures. Getting higher revenue in will ensure, and similarly doing an expense forecasting. Not spending your money before you've actually earned the income. So realizing if I earn all this income, what would I do? Would I spend it on new technology? Will I hire more? But understanding keeping profit in place. And that is what I will talk about in my session next time on profit first and financial prudence, a lot on how we do this reverse engineering process. But here I want you to highlight that understanding these figures, using it effectively as leading indicators to ensure your lagging indicators are matter, and looking at these numbers so that you can take decisions based on it, making sure you're getting it on a timely basis. These figures are accurate and reliable so that they become relevant to your business. So that's it from me, guys. If you have any questions and answers, feel free to ask them here. I'll meanwhile look at a chat and see how does one value the intangible assets? So in the valuation process, there is a method called goodwill. So depending on how long your business, there are formulas to be able to measure these intangible assets. So if you've done a branding exercise, so someone buying your business today is not just buying the actual sales figures, they're also buying the equity that you've built over, the name that you've built over the years. So the longer you're in business, there are effective measures in the valuation system that allow you to measure it. And again, I'm bringing another topic here. It was not something I was said. I'm also a certified value builder with Build to Sell. So there are 8 drivers that drive your business forward. So normally, if we were to doing the valuation, we would also ask people to fill this questionnaire, which is a complimentary questionnaire, to fill it so that we can add value. So if you have data sharing good customer service, if you have data on predictable revenue on your future forecasts, all that will help you to get a higher valuation.
Awesome. Awesome. I have one question. I think one question is missed out. Kiran was asking, how do you keep a tab on cash flows?
Yeah, so there are a cash flow is, what money is coming in and what money is going out. So number one is to track it. Number one is also in accounting systems. I've not brought those 2 words here, is accounts receivable and accounts payable. So, even if you use the system, you can trigger and find out how much you have to receive from your customers and how long. It's called aged receivables. So, whether it's pending 30 days, 60 days, 90 days, and same thing for your payables. You do aged payables as well, find out how long that you've not made the payments, and understanding and forecasting that helps you keep a tab on your cash flow. Cash flow management is important. So you have to do, again, forecasting on your cash flows so that if you have to negotiate something, you negotiate well in advance. If your money is due to someone and you'll not have the cash flow to pay it, you can convert it to an installment plan and tell them that the idea is not that people will say no, pay me. The intention that you are going to willing to pay them, and same thing, the intention for your customers who've not been able to pay you is to arrive at some kind of a solution where that payment has come, and have an agreement saying if it's not coming by then you'll pause the service or whatever. But maintaining that cash flow forecast, understanding what you're expecting when, you'll have to maintain it in a cash flow statement.
Okay, thanks, Simran. Thanks for that. Can I ask you some questions for my
Absolutely.
my
Absolutely. Yeah,
so
you can.
One of the things that most of the entrepreneurs face with their startup experiences, and we've seen 3,000 of them experiencing that, is that they don't know how much to price their products if they are out of cash, the pricing strategy and how it impacts cash flows. You touched base upon it, but since we have about 7 minutes, I'd like you to talk about that. And this is about solopreneurs, right? This is about people who are just starting off and who have who want to try to put the cart before the horse kind of a thing, but they don't know what to do and how to do it. How do these principles help them navigate that? How would these principles?
Yeah. So now what happens is, again, I'll mention a few pricing strategies here. A lot of people would take the pricing, and it depends on whether you want a leadership pricing. So you have a product that's new to the market. It doesn't matter. You're doing a high value, and you feel you can get more people on that value. Some people will say the cost of my product is X and I will do a 20%. So it's called cost plus pricing. Some people would say, I want to disrupt the market, and there's a disruption pricing where you price it at a certain level because you're targeting volumes or you're targeting value. Right. So if you're targeting volumes, you'll price it at a pricing where you'll get high numbers picking it up at that pricing. Okay, so whether you want to break your competitor and do that. So depends on your long-term strategy where you will choose your pricing. Now, all pricing cannot be chosen and have it at the same time. You may have two different products and you kind of brand it a little differently. One could be a low-level pricing, one could be a high premium product pricing. Okay, so what I believe that if you want to give a summer offer and today you want a cash inflow, you have a strategy where you will say my price is so and so, but my summer offer is so and so. Okay, so what you're doing is you're not devaluing your total price, but you're giving a discount, or you're doing bundle pricing where you're bundling multiple products and say that if you buy this with this, then the total price is, you see a lot of bundle offers coming into the market. So you can choose bundle pricing when you want that quick cash flow, right? So you can choose your cash flow pricing, market it differently.
Mm-hmm.
So if you have courses or products or services, what you feel is that maybe, people are not buying my high value course. You do sections of the course and say, I'm selling this as a separate course, an element of my big course. So what happens is they buy it at that price. If they like it, then they are willing to buy more. And something else that I talk a lot about my build to sell, and today I believe that is where the economy is going, is subscription basis. Okay, so not just pricing a product, but I would say if you have a product, you wrap a service around it. So for example, in build to sell, they say, so for example, if you're an IT company and you have these CCTV cameras that people are putting in your house and your office. So when you do a CCTV camera, normally when you're going to sell the business, it's normally $1 to 75 cents is what you get. But if you wrap an AMC around it, and you see most of the IT companies are doing it, you have predictable income coming to you, even if they're smaller income. Okay, it's not selling one product. So if you have a product, see if you can wrap a service around it. If you have a service, see if you can productize your service. So for example, accounting, you create it as like silver, gold, platinum packages. So it's very easy for people to buy it as a product rather than saying, okay, I'll customize the service for you. So what makes it easy for you? So product pricing, package pricing. So elements that you will do to separate even your products, there are different strategies. Have I made it clear, or you have any other questions?
Yeah. So I think that's very clear in terms of the pricing strategies and how that would impact, a lot of the things from a cash flow flexibility perspective. These entrepreneurs or our members mainly have another issue of looking at expenses that are, formative investment purposes. So what is your take on as a small and micro business? You have so many clients who are small and micro business owners.
Right.
What kind of investments or expenses should they still incur, even if they are not directly related to their profit or their revenue? What do you suggest, and what are your recommendations? And you've seen so many books of accounts, and what is your take on that?
So again, I will cover it in my profit first stuff, but what I ask everybody to look at is, look at the word expense as an investment, right? So every dollar or dirham that goes out should be coming back and bringing you back stuff on a multiple basis. Okay, so return on your investment. I would even call it ROTI, return on your time invested that you're putting in. So what happens is, look at every expense and ask the question, is this contributing to profit directly? So I know when you said if it's not contributing to profit, right? So if it's not contributing to profit, is it helping my customer journey? Is it making easier for my customer? A lot of the marketing expenses, okay, would be considered investments because you're not going to get the return today. You will get a return at certain period of time. Certain investments in technology is making the user interface in e-commerce easier for the customer to go and buy your product. So at that point, you will not say that I'm not going to spend money on it. A lot of people will say, listen, 100,000 dirhams on Google Ads, I don't want to do. But if I tell you, for your industry, if you invest 100,000, you will get 1 million. So what's your return on your ad spend? Okay. Now, if your customer is not there on the platform and you're spending, it doesn't make sense. But what I'm saying is marketing will always be an investment. So if I were to look at it and I were to look at stuff and tell people, I will definitely tell people to invest in marketing, invest in technology that helps your customer journey. They may not be giving you returns tangibly, but at some point it will give you more customers, which will eventually give you more money. So definitely investment on marketing, investment on things that are directly contributing to profit. Absolutely, you'll have to put your money on that.
Great. I think that answers quite a bit of, things. Anything else? Any last words, Simran?
Yeah. So if anybody needs our assistance, I know my profile is not yet on your system, but I will get it done in the next 2 days. What we are offering clients is if you just want a setup of your accounting system by us and still run your own accounting yourself, I will share that on the platform later on, and you can put it up on the platform, Arvind, and they can get it set it up from us, and then we will set up the accounting software for them, which is cloud-based, which could be Xero, Zoho Books or QuickBooks, and we will create a VAT compliant invoice for them so that they can start keeping their records in place.
Lovely. Is there a price, like a price for that?
Yes, we normally charge 4,000 for it, but as a for startups, I understand their startups will do 1,950 plus 5% VAT.
Okay, that's great. That's really good. I think a lot of them will take this up. And for those who have attended and joined and then bounced off, usually this is a pre-recorded session, which whoever has registered gets access to it. So they will have access to this, and they will definitely reach out to you. Once you join the group, I think there's going to be more chatter for you.
Sure. And they're I can also give a 15-minute consultation if they just want complimentary, if they just want to understand how this applies to their business if they're watching the recording.
Amazing. Awesome. Great.
Or if the question answers are on the chat, I will answer that on the chat.
Yeah, but these chat ones are done. That's fine. I think they will have answers once they've seen the recording if they've jumped off. So yeah, thank you so much for your time, Simran. It's always enlightening, whatever you give in terms of your piece of information and advice. So thank you once again. We're looking forward to having you live as soon as possible.
Sure. Thank you. Thank you for the opportunity. Thank you.
Thank you.